Hey guys, your family stock storyteller Emily is here. Today I'm bringing you one of the most interesting stories in the entire energy sector. A company that has lived through every oil cycle, paid dividends for 55 straight years, and still stands as a global powerhouse, ConocoPhillips. But this story isn't a straight upward line. Yes, there's strong financial discipline and solid execution, but there are also billion-dollar headaches. Before we dive in, let's set the stage. COP is trading around $88 with a market cap of about $108 billion. The dividend yield sits at 3.82%. It's low volatility, steady, calm. And yet analysts still see close to 30% upside from here. So this is a big, stable company, but not a boring one. When we look at third quarter numbers, we see classic ConocoPhillips performance. They beat expectations with earnings of $1.61 per share. Analysts expected $1.45. They generated $5.4 billion in operating cash. And just in this quarter, they returned $2.2 billion to shareholders. Tempting? They even raised the base dividend by 8%. So despite tough market conditions, the company pretty much said, "We're doing our job." Of course, not everything is perfect. Revenue came in slightly below expectations. Analysts wanted $14.78 billion, but COP reported $14.55 billion. It's not a massive miss, but markets react quickly to things like this. And yes, the stock pulled back a bit right after the announcement. Now let's talk about the most controversial part of the story, the Willow Project in Alaska. This thing is supposed to be COP's big long-term engine, but costs have gotten messy. The project was originally expected to cost between $7 and $7.5 billion. Today, that estimate has risen to somewhere between $8.5 and $9 billion. The company says around 80% of the overrun is due to inflation and North Slope construction cost escalation. The good news? The schedule hasn't moved. First oil is still planned for early 2029. Willow isn't just another production site. It's the project that will reshape COP's future cash flow. From 2026 to 2028, the company expects its free cash flow to increase by about $1 billion per year. But the real jump comes in 2029. Once Willow starts producing, cash flow suddenly grows by an additional $4 billion. That would nearly double the company's 2025 free cash flow. This is massive. While everyone is focused on Willow, COP is quietly building a global LNG engine. Most of their LNG capital projects are already 80% complete. They secured a $600 million capital reduction thanks to the Port Arthur Phase 2 credit. And they continue signing additional regasification and sales agreements in Europe and Asia. This is a decade-long strategic positioning, not a short-term move. Financially, COP looks solid. They're sitting on $6.6 billion in cash. Their debt is moderate and manageable. And remember, this company has paid dividends for 55 straight years. Very few energy companies can say that. Of course, there are risks. Willow's cost overruns frustrated investors. Oil prices have fallen about 10% this year. The company only expects 0 to 2% production growth in 2026, which is very low for a major producer. Many analysts have been revising their earnings estimates downward, and the stock has lost almost 20% over the past year. When we check the technical side, the picture doesn't get much better. The 3-month trend is weak. Most moving averages show a downward signal. Almost every major technical indicator points to sell or strong sell. In short, the fundamentals are solid, but the technicals are not. But the long-term story is completely different. By 2029, Willow could transform this company. The LNG strategy could give COP a huge margin advantage in international markets, and the average analyst price target is still above $110, so patient investors might see real value here. If you're looking for a fast, exciting short-term stock, COP is not it. But if you're a long-term investor who likes stability, steady dividends, and a clear future catalyst, then ConocoPhillips deserves a place on your watch list, especially as we move toward 2029, because the company's financial profile might shift to an entirely new level.